Now let's analyze who was Nasdaq and what was the main problem. So it's an American first electronic stock exchange at One Liberty Plaza in New York City. It is usually known for high tech quality, but volume of Facebook shocked the system. We can say that since if you have a glitch on such a high profile IPO like Facebook, well, now people will start to question the capabilities of Nasdaq and they can doubt about Nasdaq. And these glitches affected um, millions of people, mainly the investors that we can see from the video. And well, the problem was mainly Nasdaq attempted to do a continuous cross, and they were accepting orders right up in milliseconds before they even tried to come up with the IPO share price, which may lead actually they did lead the problem of inconsistency between the prices, and due to the high volume of orders, Nasdaq people want to check the orders and the books were changing, and well, that made such a big problem, especially for the investors in that time. And well, to solve the issue, they offered a compensation package of $40 million, but well, that was not the most efficient solution since this package mostly consists of discounts for brokers to trade in Nasdaq, not in cash, and this compensation could not compensate basically all the retail investors who suffered because of this problem. And to explain mainly what was the main problem is that just in a phrase is Nasdaq had the knowledge of a software problem, but they failed to solve the issue.
Now, let's speak about the perspective of the retail investors. Retail investors were really upset to find out that the Facebook's upcoming IPO was such a mess. There are a couple of parties to blame. For example, the Nasdaq for having technical issues, the brokers for not executing the trades, or even the retail investor themselves for not being cautious enough when buying the stock after the unprecedented week that they had had. Retail investors encountered a couple of problems which made it so controversial. The first one was that the shares went public at half an hour later than expected. This caused a lot of uncertainty for the retail investors, and what many investors did was that they had buy orders, for example, at a specified price, and when they saw that the market orders were not being executed, they panicked and they started to close positions. Some even got a confirmation from their broker that their order had expired at the end of the day, but their trade were still executed by the brokers. Um, Buy orders that were supposedly not executed were executed at a lower price too. And third, investors got the shares days later with no ability to manage the position or no ability to put a stop loss to it. Additionally, no knowledge of investors even having the shares. So some investors owned the shares, but they didn't even know about it because the brokers they didn't tell them, and the Nasdaq had technical problems about it. Supposedly, what had happened is that Nasdaq had technical problems, even though they had tried this system beforehand and had ran very different scenarios. But one of the reasons for this was because less than week before the IPO, the amount of money that was going to be raised through the IPO was increased by 25%. So I think that this may have caused the technical errors in the Nasdaq system and was definitely a reason why the share prices plummeted. Since there was more supply and relatively the same amount of demand, the share price definitely went down because of that.
What exactly Facebook did wrong for this IPO? An IPO roadshow is supposed to be this high machine for companies' prospects. And then for Facebook itself, its internal new forecast showed that revenue was actually going to be lower than expected. The reason was that users were flocking into smartphones faster than the company could serve mobile ads. So before the IPO, Facebook has disclosed this to Morgan Stanley, which was their leading book runner, about their revenue projections. Even if this change was small statistically, this would really kill the momentum, and that's all IPO about. So the Facebook and the bankers at Morgan Stanley had to make a public disclosure. So what they chose to do was to file an amendment to the public birth certificate, the S1 document, but they didn't have to highlight the changes in this document, and so most people won't notice about it. And the second point is Facebook would call all the research analysts in the investment banks to inform them about this weakening projections. Now, the problem with this amendment to this S1, as I mentioned, is that it not only did not highlight the changes, but it also um, did not mention specifically the amendment to the revenue. They were just mentioning, the users was growing fast, and the trend will continue. Some vague words about it, so people would definitely not notice about it. And after having this call with all the research analysts about with J.P. Morgan, Goldman Sachs, Citigroup, all the research analysts at the big banks, they knew about it, and they all cut their revenue estimates by around 3%. So because of this amendment, the banks knew about it, so their clients knew about it. So the smart money, so called, actually were well informed about this change in revenue, in this outlook. So there were a lot of institutions were betting against Facebook's share price, knowing that this news, this corrected estimation, would pose a severe downturn to its share price. But all of this were kept secret from retail investors. They didn't know about this until the IPO went public.
Right. So there are three main ways in which Facebook can, to at least some degree, be held responsible for the outcome of its IPO. Firstly, the share price. The shares had an initial price range of $28 to $35, which, when looking at comparable firms, was already considered to be quite high. Later, this range was then increased to $35 to $38, and when the day of the IPO finally came, shares were then sold at the absolute maximum price of $38. This led to a short but rapid increase in the share price in very early trading, but soon after the shares lost all their gains. The next way in which Facebook doomed their own IPO was a last-minute increase in the number of shares for sale. It's very common for investors to ask for more shares than they really want in hot IPOs, as they will most likely be scaled back. Just in Asia alone, the sale was 25 times oversubscribed. By increasing the number of shares offered by 25%, many of the investors then ended up with more shares than they had expected, which practically forced them to sell again shortly after the IPO. Since the share price was up, this was then turned into an opportunity to make a quick buck. So many investors ended up selling, which further drove down the share price. What then ended up hurting the IPO even more were news of many of Facebook's early investors increasing the size of their sell-offs. It was estimated that approximately 57% of shares sold came from Facebook's insiders. Needless to say that this had everything but a positive impact on the further development of the IPO.
There was a big issue with the initial public offering of Facebook, namely lack of transparency, as was said by James before. It highly affected the understanding of investors and shareholders. Transparency is a pivotal feature in the market-based monitoring of companies, and it's central to shareholders' ability to exercise the ownership rights on an informed basis, which can help attract capital and maintain confidence in the capital markets. Based on an article of Yahoo Finance, there was also a lack of confidence in the stock, as 57% of the shares sold in the IPO came from Facebook insiders. Also, before the IPO, General Motors decided to pull $10 million in advertising from the site, claiming that the ads had proven ineffective. Facebook should have been more transparent with the values and with the financial data they obtained before. More, Diego will say about other issues that could be done more better.
Facebook set the highest IPO price within the range given by the financial institutions involved, while also increasing the size of the offering. It's likely that Facebook did this knowing that this would result in an overvaluation of the stock, which would mean that they knowingly sacrificed the satisfaction of many investors, especially retail investors, who suffered from a lack of transparency as well, like mentioned by Kanan. However, it's arguable that the IPO was in fact successful for Facebook, as they were able to raise a large amount of money. This IPO could have been one of the great catalysts in the expansion of the company, and I'm sure people are able to justify the decision, saying that they used the money in order to expand and the shareholders would then receive the value in the future sometime. However, in our opinion, Facebook had to find a trade-off between raising a large amount of capital and satisfying their potential investors. Although the consequences of said decision were not fully predictable back then, I don't think Mark Zuckerberg and the financial institutions intended for so many people to suffer, they still consciously made the decision to prioritize the IPO size over the investors' returns. Yes, you can argue that Facebook stock has skyrocketed since, and it was still a good investment if you kept it for long enough. But there were many retail investors who didn't know the proper risk management. And it's very important for investors to understand what they're buying into. For example, the video talked about how a man lost a lot of his investment because of a margin call. Yes, he could have held the stock for long if he had structured his investments better, but it was also largely due to the decisions made by Facebook. Therefore, if we were to conduct the IPO in a different way, we would have chosen a much less extreme side of the spectrum between IPO size and investor satisfaction. This would include a more moderate IPO size with the idea of building long-term, meaningful relationships with investors in which shareholders can trust the company and its transparency.